All right, let's jump right in because we've got a genuine economic puzzle on our hands, one that's affecting millions of people who are just trying to buy a home. We're calling this one the mortgage rate mystery. So here's the deal. Mortgage rates are actually climbing. At the same time, pretty much everyone expects the Federal Reserve to cut its main interest rate. Now that just doesn't add up, right? It's the complete opposite of what you'd expect. So what on earth is going on? To crack this case, we're going to break it all down. First, we'll look at what's really happening out there, then why it's so weird. And, of course, the most important part, what it all means for you and your money. And listen, this isn't just some abstract numbers game for Wall Street. Nope. This hits close to home literally because it messes with the single biggest purchase most of us will ever make. Something is definitely off. Okay, so before we dive into why everything's gone a little sideways, let's do a quick recap of how this is supposed to work. To understand why the rules are being broken, we first got to know what the rules are. Normally, it's like a set of dominoes. The Fed hints that it's going to cut rates. So traders trying to get ahead start buying up a bond called the 10-year Treasury. That buying pushes its yield, which is just a fancy word for the return an investor gets, down. And when that key yield falls, mortgage rates almost always follow suit. It's a pretty predictable chain reaction. And why do we care so much about this 10-year Treasury? Well, think of it like this secret sauce for 30-year mortgage rates. Lenders look at its yield to help decide what rate to offer you. It is the crucial middleman between what the Fed does and the rate you see online. All right, so that's the playbook. But here's the thing. The market seems to have thrown that playbook right out the window. And this is where our mystery really gets interesting. Get this. Just this week, the average rate on a 30-year mortgage actually jumped up to 6.36%. That's its highest point in 2 weeks, and again, the exact opposite of what should be happening. And that secret sauce we were just talking about, the 10-year Treasury, its yield also went up, hitting 4.17%. So instead of falling like it's supposed to, it's climbing, and it's dragging mortgage rates right up the hill along with it. And this isn't just a blip on the radar. I mean, these rates have been incredibly stubborn. In fact, it's been nearly 3 years since we saw a 30-year rate that was below 6%. Even when it hit its lowest point this year, it barely dipped to 6.13. So this is a trend, for sure. So what in the world is going on here? Why is the market going completely rogue? It's time to put on our detective hats and see if we can find some clues. And hey, it's not just us scratching our heads. The pros are confused too. As one expert, Jeffrey Rubin, puts it, the market is just not behaving as it traditionally would. So that confusion you're feeling, it's spreading everywhere, even among the experts. This really is the million-dollar question, isn't it? If the old playbook is out the window, what new rules is the market playing by now? Well, according to our research, there are 2 big clues. First, inflation is still hanging around. If investors are worried that inflation is going to keep eating away at their money, they're going to demand higher interest rates on long-term loans. Makes sense, right? And second, traders might think this next rate cut from the Fed is a one-and-done deal, the end of the line. And here's why that matters so much. The Fed's current rate is actually getting pretty close to what a lot of people consider normal, which is around 3%. So traders are betting that after this next cut, the Fed's going to say, all right, we're good. And if no more cuts are coming, well, there's just no incentive for long-term rates like mortgages to fall any further. Okay, enough with the bond market jargon. Let's bring this all back down to earth. How does this weird situation actually affect you, your wallet, and your life plans? Well, what we've got is a classic case of hope versus reality. The hope from policymakers was that Fed cuts would make borrowing cheaper and really get the housing market fired up again. But the reality is that these stubbornly high costs have the market totally stalled out. It's stuck in neutral. And that has some serious real-world consequences. It means potential homebuyers are stuck on the sidelines, completely priced out by the monthly payments. If you already own a home, you might feel trapped because you can't refinance to a lower rate. And this is all happening while, everything else, from groceries to car insurance, is getting more expensive too. So, this all leads us to one final really big question. We've always just assumed the Federal Reserve has its hands on the economy's steering wheel. But when the market just stops listening to its signals, you have to wonder, is the Fed really in the driver's seat anymore? That's definitely something to think about.